Time for All Things Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain Company in New Bern, here's David Blain.
Money! Hello and welcome to All Things Money. I'm David Blain, your host for the next 30 minutes. We'll be talking about some topics related to investing and taxes and maybe some real estate here and there. We try to keep the show interesting and entertaining for you so you get some value to help create or maintain wealth for you and your family. The show is about you and your money, so we try to address topics and questions that you'd like to hear about. The only way we know what you'd like to hear about, obviously, is if you let us know. So please feel free to give us a call at 633-0107 or send us an email at allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. And let us know what you're thinking. Let us know what you'd like to hear about. If there's a topic or a question that you don't understand, there's a lot of media out there. You know, you've got the TV, the CNBC, you've got the newspapers, Wall Street Journal, you've got other people on the radio. We try to give you the unvarnished truth here so that you can prosper and profit in these uncertain economic times. So let us know what questions you have. Also like to point out that our website, www.dlblain.com, that's dlblain.com, has some good information on our company, as well as we keep archived copies of the shows on there. If you miss a show and want to go back and listen to some, we post them there shortly after the show is completed. So today we're going to start off with a discussion on some taxes. As you may or may not know, in about, seeing as how it's September, just about, depending on when you're watching this, we've got about 4 months to go until one of the largest tax hikes in history. If you haven't been paying attention, we'll kind of give you a quick summary. If you have been paying attention, maybe we'll add a few pieces of information that you hadn't heard before. On January 1st, 2011, we'll begin the start of 3 waves of tax hikes. The first wave, which is the expiration of the 2001 and 2003 tax relief. These were enacted by the GOP Congress. Many tax cuts that were enacted are set to expire January of 2011. And I remember when these tax cuts were enacted, and it seemed like so far away. Oh, they're going to expire in 2011. Oh, well, they'll definitely figure out something to do between now and 2011 when they expire. Well, here we are on the eve almost of 2011, and Congress has failed to do anything to address these taxes. And so the rules, when they were passed in 2001 and 2003, in order for the GOP to get them passed, and both parties to agree, the House, the Senate, the President, one of the compromises they made was that they would automatically expire if not renewed or changed. And once again, nobody thought they would actually expire. Well, they are going to. And unless Congress acts in the next few months, they will expire. And here's what's going to happen. The top tax rate is going to rise from 35 to 39.6%. And the bottom rate will rise from 10% to 15%. And I know that there's been a lot of populist anger out there, and a lot of talk of taxing people of $250,000 of income and above, and making these people pay more. Well, the reality is this tax hike, if you look at it, someone in the 10% tax bracket going to 15%, that is a 50% tax hike. Now, granted, the dollar amounts are very low, but someone in the 10% tax bracket that now will be in the 15% bracket, that is a 50% tax hike. Someone going from the 35% to the 39.6%, which is the highest bracket, their taxes will go up 13%. Now, I point this out not to say that I think the higher brackets should go up more. I don't. I think they're too high already. The point is that It's disingenuous when people are saying that these tax cuts are not going to hurt the middle class and lower income people, because actually their tax brackets are going up the most. So you really have to delve into the numbers when looking at this, and look behind the reports maybe that are coming out in the regular media. The marriage penalty will return, and what this essentially means is that instead of doubling the standard deduction and exemptions and other things for married couples from the single rate, they're not doubled. Part of the tax relief was that they made this adjustment so that married couples were essentially treated equally as two singles. Well, that is going away. The child tax credit, which went up to $1,000 per child, will go in half to $500 per child. Once again, this is a very regressive tax increase that people at the lower income levels, that $500 tax credit is going to be a much larger percentage of their tax bill than someone at the higher rates. And also the dependent care tax credit will be cut. Once again, higher income people, a lot of them, maybe the spouse doesn't work and so they don't need the dependent care credit. At the lower income levels, you see a lot of two working spouses, and that dependent care credit is going to be cut. So my point in some of these first things is that I'm not advocating that we raise taxes more on people that make more money. I'm a firm believer in tax cuts to stimulate the economy. The point is that if these tax cuts expire, a lot of it is going to be borne by the lower and middle class. Is something that you haven't heard about, and so why Congress is not acting to extend these tax cuts is really beyond me. The other thing that is coming back in 2011 is the death tax. As you may or may not know, in the year 2010, if someone dies, there is no estate tax. Now, the exemption, of course, is $3.5 million, but there's no estate tax. So George Steinbrenner, the owner of the Yankees, passed away in 2010. And unless Congress does something very nefarious, such as go back and pass some sort of retroactive tax, his whole estate, including the Yankees, will pass tax-free to his heirs. Well, starting next year, the exemption amount drops to $1 million, and the tax will be 55% of the amount of an estate over $1 million. And this is what happened to the family that owned the Chicago Cubs. When he passed away, they didn't have enough money to pay the estate tax, and so they were forced to sell the Chicago Cubs to the Tribune out there in Chicago. Steinbrenner, because there was no estate tax, it will probably continue in his family. We'll pick up on this when we come back, but we're going to take a quick break for a message from our sponsors for All Things Money. This is David Blain.